Hello everyone, James O'Reilly here from Northeast Wealth, and I'm here today to take you through the Australian Retirement Podcast and a really important episode today, how to manage a falling portfolio balance. Now, as always, I'm here with my host, Drew Meredith. Drew, how are you, mate? Oh, okay. Drew's not here, and the reason he's not here, he's got a good excuse. It's school holidays. He is looking after his kids, but I'm going to be running this one solo. I'll do my best to keep this as engaging as possible. Normally, Drew jumps in with a couple little quips here and there, so I'll try to fling those off the cuff just to make it feel like he's here. I know it's important to a lot of people listening, but most importantly, we really do want to dive in here and talk. It's such a relevant topic right now. So many Australians, pre-retirees, retirees, everyone are experiencing significant falls in their investments. And we really wanted to have a podcast that we could put forward for you, which would help you to understand the things that you should do. I've broken this down into 3 separate sections. Firstly, what can I do to minimize risk during a downturn? Secondly, what can I do to profit during a downturn? And then lastly, what are the rules of thumb that might apply to retirees and pre-retirees that can hold you in good stead through times of high volatility? So we're going to jump through. We've taken the liberty of putting together some good quality research and looking at some good resources, which we will include in the show notes for you to peruse later on. But let's kick off. We're going to firstly talk about what can you do to minimize risk during a downturn. Well, this really depends on what type of risk you are trying to minimize. So to expand on that, if you're looking to minimize volatility, well, then one of the obvious things that you can do is you can reduce your exposure to growth assets. Now, by doing that, that would involve selling down some, or hopefully not all, but some to all of your growth of assets like shares and property, cryptocurrencies, those assets that typically have higher volatility, and you own them with the objective of trying to get higher capital growth. So those growth assets, if you're less exposed to those assets during a downturn, then traditionally you're going to get less volatility in your portfolio, and that means that hopefully you feel less of that pinch when markets are going haywire. Now, there's some consequences of that, though, which we'll talk to as we move through. Certainly, though, that's an obvious one. If you want to minimize volatility, that's your core objective. Perhaps you're feeling super stressed about the markets and it's really worrying you, then looking at your asset allocation and whether it's making manual adjustments to that or maybe a larger scale change from asset allocation A to asset allocation B, which some super funds, for example, will encourage you to do. You might, for most industry super funds, it's very likely that your asset allocation is going to be a preset mix, like you'll be in the Australian Super Balanced Fund, for instance. And so changing that allocation, you couldn't say to Australian Super, can I please just sell out of the growth component or sell out of the shares component and keep the rest exactly the same? You'd have to shift from that balanced component to a moderate component or or conservative or something different. Let's talk to the second way you can reduce volatility, and that is to avoid assets which are traditionally more volatile. So even if we said, no, we feel like we've got the broader asset classes right, I've got the right allocation to growth stocks and defense and growth assets and defensive assets. The next question is which growth assets do you own? So of course, if you have really high exposure to traditionally more volatile assets, like, for example, emerging market shares. If we're looking at emerging market equities, historically, they have had much higher volatility during times of significant share market rebalances and these wobbles, whether it's bear markets or corrections. And similarly, for small caps, if you have a huge amount of your money or a really high proportion of it allocated to small shares, so we're not talking about the biggest players in the market, which of course we'd consider to be globally. We consider your Apples and your Amazons and your Metas. Domestically, we consider the Commonwealth Bank, most of the banks, your Rios, your Fortescue Metals, those sorts of producers. Instead, we're down with the more obscure stocks where you're hoping to get much higher returns from, and maybe you've been doing some great research and maybe they're really, really good stocks. But the reality is that small cap stocks are typically going to get hit a lot more heavily. There's a lot of reasons for this, but one of the primary reasons is that with small cap investments, typically they don't pay a dividend. And if they're not paying a dividend, then there's really nothing to anchor the value of the share price on other than the likelihood of where they might be in the future. And so conversely, if we move across to we all know the Commonwealth Bank, Drew and I have got a live bet, which I'm winning, by the way, about where the share price will be in, got to be what, 8 months from now. And one of the things that holds the Commonwealth Bank share price in good stead, despite really high volatility in equity markets, is the fact that the CBA pays a very healthy franked dividend, and investors can say, oh, well, the investment performance has been terrible from a capital perspective, but I'm glad I'm getting that dividend, and that's looking after me there. The last piece here is around avoiding over concentrations to only a handful of stocks. It's common when we sit down with investors at Northeast that someone, particularly those who have taken control of their portfolios, you develop a romantic interest with a couple of different shares in particular, and you read all the forums and you understand the financials and you've looked at them in detail. And it's not uncommon at all that we have to talk people off a ledge, as we describe it, to say, hey, you may very well know this, you may know the share better than we do. And it's not necessarily going to be practical for me to invest the 10 to 15 to 20 hours in order to get up to scratch to the level that you're up to scratch with this particular mining fund or mining share or whatever it would be. But what I can say is that regardless of how well you know this share, this is too much. You own too much of it as a function of your entire portfolio. And of course, as you can appreciate, diversification, we've talked many times about, is the idea of not putting all of your eggs in one basket. And if right now you have all of your eggs in one basket, you have real over concentration to some of these positions, then the problem that you may very likely face is that you're going to get hit a lot harder from a volatility perspective. We talked about different risks. Volatility is one of them, but another risk that you might be looking to minimize, you might say, I'm not too worried about the volatility, and I know that the markets are going to move around, and I've been through the global financial crisis, and I went through the COVID fall, and I went through the dot-com crash, and I know what happens, and I'm feeling okay there. But really, my bigger risk is running out of capital. I'm a pre-retiree or potentially a retiree, and I'm mindful that my superannuation balance, perhaps that's your only investment asset, not uncommon for a lot of Australians, my superannuation balance is actually the only thing that I've really got to rely on in order to have a comfortable retirement. Well, depending on your asset balance and, very importantly, the income that you're going to need when you retire, or so either expected to need if you're a pre-retiree, or actually I need because I am a retiree and I'm taking that income regularly, the best way to minimize the risk of running out of capital for many, many, many Australians is actually to do nothing. It's to stay exactly where you are. And I'd love to talk about some of the reasons why that is the case, because hopefully it does influence a lot of people to rethink that natural knee-jerk reaction to say, I just have to do something. Things are not going well, so something must change. There's a fantastic research piece that was put out by a group called, got to make sure I give them the thumbs up here, Neuberger Berman, which is an investment firm. They're in New York, and they have a particular insights, which I'll share in the show notes. And it does a really good task of outlining this point well. It was completed in May 2023. Insights around market volatility always happen straight after volatility, because everyone's always trying to say don't panic to everyone, and so that's the time you're always going to get the best data. So in the future, by the way, if you ever want to try to find the insights around volatility and downturns, just look for a couple of months after the most recent downturn and you'll get the best stuff. So if we go into this, there were a couple of really important lessons to take from this. It was looking at data in the US market, US equities market, since 1950. So firstly, really long-term data. But secondly, the US equity market is, in my opinion, the most appropriate market to use if you're going to look at doing this. It's quite hard to get this data across a broad range of different equity markets all at the same time. And then, of course, you've got the issue of what composition is best. And similarly, the US market is the best proxy for global share markets, and that's why we've chosen to rely on it. So in this case, if we're looking at bear markets in the US since 1950. And just to be clear, a bear market is defined as an investment market that has fallen by more than 20% from a closing high. So in fact, I'm going to move on. You're all switched on human beings. I think you've all got that. The bear markets in the US average 11 months from peak to trough. That's the average across, I'm just looking at this, let me see, like 20 bear markets from, actually it goes back to September 29, which is, of course, with the Great Depression, the crash of 29. So given we're looking at over 100 years and around 20 bear markets, the median time from the peak to the trough is 11 months. Now, coincidentally, of course, you've also got periods where the peak to trough is 1 month. And we can remember a market event that happened very recently for most of us in relative terms, which was COVID. And when we had that huge free fall in February, March of 2020, and we blinked, and not only had it gone straight past that its previous highs, but then continued to rocket on for another 2 years and put tremendous wealth into anyone who was holding investments at that time. So there's obviously a big range here in terms of peak to trough. The longest I can see here is 33 months, which was the crash of 29. Notwithstanding, there was another 6 months again in September of 32. So then that's overall, we'll talk about sort of 40 months or thereabouts. More recent times, the maximum was 30 months, which was the .com collapse. And then since then, GFC was 17 months, COVID 1 month, and 10 months for the Ukraine war, and then also the big stubborn inflation thing that we're still dealing with right now that took place in January 2022. Now, for those of you that are curious about why I'm using a mean, just while we're here, of course, they've got a median. They've got a mean and a median. As a reminder, if you can remember your grade or year 7 maths or whatever it was, means will obviously take an average of all the data, and they're very effective. But the problem is that when you get outliers at extremes, then it's taking those into account too. Medians will more or less remove those outliers, and so you get you get a better representation of what the central tendency tends to be. So firstly, 11 months peak to trough. That's not a very long time in investment markets. And hopefully if you're thinking about this with 5 years to go before you retire or something along those lines, you can see that perhaps this is not going to be the years and years and years long thing that a lot of people, and at least a lot of news media agencies, would like to convince us it is. The second thing that I took from this is that the average, the max drawdown, which is the amount with which it's fallen from peak down to trough, the median there is 32%, which is a big fall, about a third of portfolio value wiped. But it's very important to recognize, of course, that that number changes depending on your asset allocation. So if we go down a little further, they solve that for us. So thank you so much. Very appreciative of this paper. And it talks about the maximum drawdown from 1980 to 2022 over the same time frame, taking into account different asset allocations. So if we go to 100% invested in growth assets, no defensive assets at all, which in Australia we would describe as a high growth investor, the average maximum drawdown was 33.3%, 1/3. Now, if we go down to 75-25, which would typically be considered, a lot of the super funds would either call that growth or balanced, depending on the way that they label it. The average maximum drawdown over that time was not 33.3, it had come down to 23.4. If we go down to 50-50, which can be named about 400 different things, but I'm sure you get the picture, 50% of growth and 50% defensively invested, well, then that max drawdown over the last 40 plus years is averaging out at minus 13.5%. Now, lastly, if you are conservatively invested, for some retirees, you might have money allocated in a way that the vast majority is invested defensively in cash and fixed interest, and there's only a small amount allocated to growth like shares and property and the like. If we go to a 25-75% balance, again, 75% being the defensive component, well, now that drawdown is down at minus 3.5%. That's the average. And as a reminder, that's a max drawdown from the absolute peak of the market to how bad it gets, top to bottom. And this is really important because in a practical sense, for most of us, the time frame to recovery is quicker than we realize. In fact, if we look at peak to recovery, so this is now going from the top of the market to the bottom and then all the way back to a point where the market has fully recovered. The median time for that across 100 years of data is 27 months, 2.5 years. Now, this blows me away, the thought that for an average bear market where the correction is over 20%, really, really big, and if you're 100% invested in high growth assets and you don't do a thing, you just sit there and wait, you'll be realistically 2.5 years out, or less than 2.5 years is the median time before that will have recovered. And I think that's really telling for me. Now, it'd be remiss of us too, to lean into that idea that sometimes the best idea, if your concern is trying to avoid the risk of running out of capital, often the best strategy is actually just to keep doing exactly what you're doing. If there's some really good data, once again, was just here, so thanks guys and girls, and that data was talking about what the growth of your investment would be if you miss some of the bigger days in the market. Some of you might have heard this, seen this example around. It's quite a popular one that gets shared at times, especially times like right now. But if I can walk you through it, it's talking about the growth of $100,000, a $100,000 hypothetical investment portfolio invested in the S&P 500, which of course is, again, the US equity market, the biggest 500 shares in the US market. And over 20 years through to March 31st, 2023, so that, of course, that'd be 2003 through to 2023. If you had invested $100,000, then it would, and you remained invested the whole time through the GFC, through COVID, through the Ukraine war, and obviously the inflation bear market we had there, you would be left with $717,000 over that time, 7x over 20 years, which is pretty amazing. But also, let's tell the full story here. It's not lost on me for a second that they've chosen March the 31st, 2003 to start, and that seems like pretty much the trough straight after the dot-com crisis. I don't think that's accidental. So they've probably picked a pretty rosy 20 years, but nevertheless, $718,000. Now, if you missed the 10 best days in the investment in equity markets over that time, just 10. Now, we're talking about 20 years. There's 252 business days in a year. So we're not too far from that in terms of the number of investment market days you've got. We're talking about 5,000 days. So if you miss just 10 of those 5,000 and you just so happen to miss the best 10, you will go from a portfolio value of $718,000 to a portfolio value of $330,000. More than a 50% fall. Which for mine that blows me away. That's a huge number. If you were unfortunate enough to miss the worst 20 or the best 25 days, you'd barely make money. You'd go from $100,000 to $160,000 over 20 years, which, to be clear, you would be screamingly better off putting that same money in cash and letting cash do its thing over that same time frame. You'd have much, much more money on a comparative basis. And so the reason why that's really important is because when we're talking about that strategy of saying, well, I'm worried that I'm running out of capital, markets have already fallen when most people make that realization. When markets are running well and everything's fine, the number of people that we had up to approach our office last year and say, I'm worried that I'm not going to have enough money in retirement is much, much, much smaller than we have had in the last 2-3 weeks, and we're going to have in the next 6 to 12 weeks, realistically, and hopefully not too long after that, but we'll find out as this unfolds. And so if you're thinking this, it's very likely that a lot of the damage has already been done. You've taken the hit on the way down, and frankly, a big hit for depending on the portfolios and the way your money has been invested. There might realistically be falls in excess of 10% in your portfolio, and no part of me is pretending that doesn't suck. But having said that, if you've already had all of that fall and you're now looking to make a change, which is going to mean reduced exposure, when, not if, but when the market does rebound at some point in the future, and again, the stats are that on average over 100 years, that's about 11 months in, noting that it's a wide range there, of course, but that's the median number. Then in that case, you're not going to get all the benefit back, and that is a problem. Now, you can also minimize risk by not taking more funds as pension payments. So For those of you who have allocated pensions, or maybe you're at a point where you are looking to set up an allocated pension in the not too distant future and thinking about the fact that, well, my asset balance has depleted. Firstly, you're absolutely right in that that's how markets really hurt retirees. Because if the balance is falling and you're forced to keep withdrawing and selling down assets with a falling balance, that's a non-ideal outcome, obviously. I'm reminded of a podcast that we did 20 episodes ago or thereabouts, where we were talking about how to invest money as a retiree, and there were we got a few questions and comments that said we think that you're probably being overly conservative, because we were talking about having perhaps as high as a 10% exposure to cash in the portfolios for a retiree, and there was some feedback that that's a bad move, because of course why would you have money in cash when you could deploy it elsewhere, and cash is typically the lowest earning environment over the long term. But what was missed there, and the reason that we had suggested that 10% might be an appropriate number, is because for a retiree, you're managing conflicting objectives. On one hand, you've got the objective of growth and trying to continue to ensure that you can self-fund with this portfolio for as long as possible. And that's essentially, it requires good returns to do so in a lot of cases. But on the other hand, you're looking at risk minimization. And to minimize risk and not have these really highly volatile events, in that scenario, you're going to have to, in a lot of cases, reduce your exposure to growth assets. Now, if this was the aggressive accumulators podcast, then that feedback would be well and truly warranted, because for someone who has lots of years to retirement, having 10% in cash is almost always going to be unwise. But for people who are on the cusp, there are quite a few meaningful benefits to having a higher amount of cash than perhaps you normally would, and this is a classic example of that. In fact, a little while ago, this would have been during COVID, as I think about it, when everyone was bored at home and drinking, I did some modeling around if you held more cash and then deployed it in investment markets when there was a correction. So to be clear, a bear market we talk about being minus 20%, a correction we describe as minus 10%. And so if you held more cash and said, I'm just going to leave it here, and I know it's financially inferior, but I will reinvest that cash, or I'll gradually do it when markets tank. In that scenario, the gap between holding excess cash becomes quite a bit tighter. And the same is true for accumulators, of course. If you're having regular contributions, that can be increasing your cash buffer. And for retirees, then if you have extra cash, then that in turn means that you might have less need to sell down assets to fund your ongoing pension payments, which is a challenge for retirees right now. Now, this has previously been addressed by the federal government. If you think back to 2008 it was, when Kevin 07, then Kevin 08, made the declaration that for Australian allocated pension holders, we're going to reduce your minimum pension payments so that you don't have to take so much of your pension money out because the GFC has ravaged portfolios. And so instead of taking, for example, 5%, they reduced that minimum down to 2.5% to give people more flexibility to take less out. Now, it remains to be seen if we'll see any of those sorts of legislative changes. But that said, there definitely is a lot of benefit, where possible, to not relying on your pension fund right now. And there's a number of ways we can do that. I'll talk about this shortly when we talk about some rules of thumb. Let's move across to what can you do to profit during a downturn? Well, there are three main ways that you can do that, and they all have to do with asset allocation. The first one is, what are your underlying assets? Based on the event right now that has created this downturn, do I hold the right composition of assets? Now, to be clear, I'm not talking here about how much growth and how much defensive you have just in a broad sense. I'm asking if the specific investments that you hold, in line by line, investment by investment, are well suited to weather this specific economic event. Or if alternatively, do we have things in the portfolio which could potentially be the landmines in the portfolio that are going to significantly pull this back? Now, if all of your retirement is all your retirement assets are in Tesla right now, for example, you've you got some big problems on your hands, and your portfolio will be screaming that at you. Now, the challenge with this particular strategy is that it's pretty hard. It's pretty hard to be able to look at the composition of assets, assuming that you're not getting professional advice. Obviously, it becomes easier if you do that, but then you're paying for it. For the average person that says, I just want to look at this myself and take an objective look, it is pretty difficult to understand that well. Certainly, you can bring a professional in to resolve that problem, but for the average person, it's pretty hard. The second option then, let's try to find an easier one. The second option is to have less exposure to growth assets as the market falls. And the reason, of course, is because, as we discussed at the beginning, less exposure to growth assets means you'll have less exposure to those falls, which should wash through your portfolio, and typically you would get a better outcome that way and be better protected. That is very hard. And the reason it is because what we're describing now is market timing. We're talking about catching that falling knife of saying the market has just started to fall a few percent, and I think this could be the beginning of something huge, and so I'm now going to make these strategic changes to my portfolio. And my experience when I sit down with people who have been doing that for any period of time is they tend to have lost money. And the reason being is because it is very, very hard to discern which market events are the ones you really want to get out of and which ones am I just jumping at shadows. We are speaking with our members a lot about portfolios at the moment, and one of the things that I recently was talking about with our members was the idea of storms versus typhoons. When you're making changes in a portfolio, and especially saying, okay, I'm going to get in, I'm out, I'm going to have more exposure to cash, I'm going to reduce my risk, etc. You are not doing that for storms ever. There are lots of storms. There are lots of storms that look like they're going to become typhoons, but they stay storms. And so what happens is, sure, there's a bit of cleanup and some cafes are closed and some little things like that. But within a small period of time, everyone gets on with their lives. And aside from needing to fix the door on the back shed, everything else is going to be fine. Some storms evolve into typhoons. They're the ones you want to be out of. And the typhoons are the ones that are going to result in everyone walking out of their homes that are hopefully mostly there at the end. And then there's an enormous cleanup. There's enormous amounts of money. Infrastructure is slowed for a long period of time. They're the market events you want to avoid. And so if we had the wherewithal to know immediately that this event is a storm and this event is a typhoon, well, then I wouldn't be sitting here talking to you. I would be in the Bahamas with infinite money and doing not much else. It's very, very, very hard for a retail investor. It's very hard for a professional investor, incredibly hard to discern between a storm and a typhoon, and therefore to know when you should be in markets and when you should be out of markets. And that's why we say it's like catching a falling knife. Most of the time when you try, unfortunately, you're going to perhaps sell down at a time when you think it's going to be the typhoon, turns out to be the storm, there's a healthy recovery, you can't get back in time, and you miss that swing. Plus, it's incredibly active management and it's pretty exhausting. So I've given you two ways to profit from downturns, and they've both been between quite hard and very hard. There's one more. And the third option that stands out is the inverse of number two. It's having more exposure to growth assets on the way back up. This is much easier. This is about looking at portfolios, looking at investment markets and saying, whoa, they are miles down at the moment. I don't know where it's going to go in the future, and I don't know how long. This is now definitely a typhoon. You can tell by the destruction that's being caused. I don't know how much longer the typhoon will go for, but I do know that it will eventually recover. I've taken a lot of the hit on my portfolio on the way down, but if I lean in on the way back, I'm going to get more returns than I lost on the way down. Now, that's not an option for everyone, of course, because it depends on your risk profile. But we have used this to good effect in the past a number of different ways for both accumulators and retirees. For accumulators, this happens naturally in a lot of cases in your super fund, because as your super fund is falling, you're getting contributions all of the way, which should hopefully be getting invested at lower price points. And so you're getting the effect of that higher return when it increases. For pensioners or allocated pensioners, it's a little bit more complicated because in most cases you won't have more money going in all the time. A good strategy that you can consider, with the incredibly important caveat that it has to match your risk profile and you have to be comfortable with this approach, is siloing an amount of money off to the side to say, okay, well, let's imagine I'm invested in a balanced manner. I'm going to take a reasonable component of my portfolio that I know that I'm not going to need for realistically at least 7 years, taking a long-term view, and I'm going to set that to the side and I'm going to invest that amount more aggressively. And I'm going to leave that to just bubble along, and I'll be at peace with the fact that I got into that investment at a discount to peak, and then I'm going to leave that for the long term. That is absolutely a way that an allocated pensioner can profit throughout a downturn, provided that they stick to the plan of leaving that money there. In the absence of it doing so well, they say, oh, well, we actually got everything that we wanted out of that. The market recovered and I got a really big return from that. And I'm going to move it all back into my traditionally allocated portfolio, however that was before, and carry on. If you are looking to profit during a downturn, I hope you can get a sense for my thinking that screamingly, option 3 is the best way to do it. Again, it's not without complexity. It's certainly not without a good understanding of risk profiling and how much worse can this get, and how will I feel if this continues to fall. But it is definitely a way of making profits during a downturn. So lastly, I'd like to move across to rules of thumb that can hold you in good stead at times of high volatility. The very first rule of thumb that stands out to me is understanding your biases. It's human nature to want to change something when things are bad. When you're experiencing pain, something's got to change. That's normal, but is that the best way to manage your portfolio? I took the liberty of looking into this again. I mentioned I did this during COVID, but just looking into it again and doing a little bit more work on this. And I had a couple of little rules of thumb that I think hopefully will support lots of you. If you have more than 7 years before you need to access your investments or super, you can safely choose to set most events aside, including typhoons, and keep contributing. So just to be clear, I don't want to be defeatist and say that is always going to be the right strategy. But if there are people out there thinking to themselves, I don't know what to do, I'm feeling overwhelmed, I'm feeling scared about this, for people that have more than 7 years until they are going to retire, your 50-year-old who wants to retire at 60, for example, you do not need to carry this fear. It is unnecessary. There is enough time for markets to recover. They will recover over that time frame, and you will have lots of opportunities to see portfolios at highs in the future. So if that's really concerning you, set that aside. There's enough to worry about in life. Don't add this one to your plate. If you don't have 7 years, but your income needs or your expected income needs, so income needs if you're an allocated pensioner or retiree, expected income needs if you're going there in the not too distant future, if the income needs are less than 10% of your total asset balance, or your like for example, your superannuation asset balance, you're also in that category where you don't have to worry about this unless you want to focus on optimization or like profitability, for example. The risk minimization piece is not something that you need to focus on. And if I may, I'm anticipating that I'm going to get some questions about that. I'll give you the simple maths on that, which is that if we assume a 33% fall, which is as we said, that's the max average drawdown over that time. That means that your pension payments, for your average pensioner whose portfolio had fallen 33%, which by the way, if you're invested in high growth as an allocated pensioner, why? But let's assume we had this crazy event where that's where it was. It's never realistically going to be that bad. In that scenario, your pension payments have now become 50% more erosive on your balance. And so what that means is that when the market is at its trough, 33% lower, every sell down that you have in order to pay for meet your expenses, that's 50% more penalizing to your portfolio. However, you've got to remind yourself here that we're talking about the absolute bottom here, and markets don't go from peak to bottom and then back to peak. They move down to the bottom and then they return back to the peak over time. So we can't use that bottom point as the sole reference point here. If it's 50% more erosive at the max, then realistically it's 25 to maybe 30% more erosive throughout the entire time, because there's going to be a period where it is only just off its peak, and there'll be a period of time where it's returning to its peak, where it's not right down the bottom. So if we have a 5-year drawdown, again, assuming 5 years is much longer than the maximum time frame from peak to trough, thinking about market recoveries, and we're assuming 10% per annum of income, that means that there's an extra 2.5% or thereabouts somewhere in the order of 2.5% is the financial penalty on your account balance by going through this year on year from peak to trough. And just to be clear, we're talking 25% penalty, as we talked about before. And then if you're taking 10% a year, unfortunately with that 25% penalty, that's gone from 10% to an effective rate of 12.5%. So over a 5-year time frame, 12.5%, including a little bit of investment returns, and so it becomes about 15. And so that's why I'm saying, like, yes, it sucks to have 15% of your portfolio eroded by going through a market event. But as a reminder, that's for someone who's invested 100-0 in high growth assets. And if we were to move this across to something more balanced, then you're much more realistically going to be sub 10. And hopefully most people where their income needs are less than 10% of the portfolio should be able to stomach a sub 10% loss in their portfolio and not have a cataclysmic effect on their long-term wealth. So that's the geek numbers for you if you're that way inclined. Under this level, it's safe for me. Now, to be clear, exceeding this level, if you're taking 20% of your superannuation balance every year, that's more concerning. If you're taking 15%, more of the same, that's more concerning. So what is your cash flow need as a function of what your account balance is? Now, if you're not in that in either of these categories and you are taking more than 10%, for example, and less than 7 years, then you should get some advice on managing these potential losses and what impact that might have on your retirement. Now, equally, if there are other ways for you to get below 10%, for example, there's other assets that you could rely on. Maybe you've got an investment account that you could use, or a cash balance that just sits there. Okay, time to start using that cash balance, and hopefully, if we've got taking more than 10% of your pension, during times when markets are low, where investment markets are low, let's reduce the minimum pension, or reduce the pension payment, ideally down to the minimum, and deplete other cash assets or other assets until such a time as markets return, and then we will go back and start taking the appropriate amount from the super fund or the allocated pension. I hope that all this adds some value for a lot of you. I recognize that it's a time whereby there really is a lot of stress and a lot of concern around markets at the moment. Hopefully this enables many of you to contextualize what's happening here and recognize that I don't necessarily need to do anything. Just to be clear, it's not to say that you can't do something and potentially still profit from this or minimize risk. But if you feel like you've got lots going on in your life and out of all of your worries, this is just another one to take on and it's a little bit too much, hopefully for many of you that positions you to say, okay, well, this is not necessarily something I have to shoulder. As always, we are here to support you. Any questions at all, please come to us. We absolutely love your questions. It's a real shame to not have fellow superstar Drew Meredith here today, but I know he will be here for the next session, and I know one of our focuses for the next few weeks is going to be Q&A, because we know that we're going to get lots of questions around investments and what do I do here or there. So if you're feeling uncertain and you want some guidance, please reach out. You can do that on almost every platform. There's in the show notes, there's a link to ask any question that you want. And as a gentle reminder too, if you're getting a lot of value from these, we'd be really appreciative for you to please jump onto whatever platform it is and sing it from the heavens, because that is going to allow us to reach more Australian ears and help more people. Thank you so much, everyone, and we will see you next Thursday.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.